Imagine authorizing a $900 million construction contract, right as your core technical division watches its gross profit plummet by 66%, simply because management decided to do the work before negotiating the final price. This is the reality of the tape. At FinWitness.com, we track and verify the public forecasts, the exact narratives institutions want you to trade on. Today, we are opening the ledger on Centrus Energy. Ticker symbol, LEU. For those unfamiliar with the stakes, Centrus is the commercial backbone for advanced nuclear fuel. They enrich the uranium that keeps next-generation nuclear reactors running. The market has been treating their recent filings like a complex puzzle. But when we cross-audited their latest 8K master construction contract against their newly released 2025 fourth quarter and full-year financials, the true capital blueprint, and the systemic risks, became glaringly obvious. Let us start with the capital overhang. When the initial 8K dropped, detailing a massive time and materials contract with Geiger Brothers, the immediate red flag was funding. The contract is capped at $900 million, but the total facility expansion in Piketon, Ohio, is a multi-billion-dollar endeavor. Wall Street naturally assumed a massive, immediate shareholder dilution, or a toxic debt spiral was incoming. But we pulled the fourth quarter tape, and the narrative shifts entirely. Centrus is sitting on a staggering $2 billion in unrestricted cash. They quietly front-loaded the pain. Throughout 2025, they raised nearly $800 million through 0 and 2.25% convertible notes, and scraped another $523 million through common stock issuance. The dilution already happened. Their war chest is fully loaded, effectively neutralizing the risk of panic financing over the next 12 to 24 months. So, why stockpile $2 billion in cash, just to hand a massive chunk of it to a construction firm? Because of the backlog. We looked at the low-enriched uranium division. They have $2.9 billion in unfulfilled orders. Crucially, $2.3 billion of that is entirely contingent on the Piketon facility actually coming online. The Geiger Brothers contract is not reckless expansion. It is the mandatory, physical bridge to unlocking over $2 billion in locked capital. But this is where the execution risk becomes highly toxic. The Geiger Brothers agreement is a time and materials contract, complete with pending markup rates and future task orders. This structure gives the contractor a blank check, if not managed with an iron fist. And Centrus has a documented history of fumbling this exact dynamic. We pulled the transcript. They explicitly stated that in the fourth quarter, their technical solutions division saw gross profit crater from $17.6 million, down to just $6 million. Why? Because they absorbed surging operating costs on their high-assay low-enriched uranium, or HALEU, contract. The expenses incurred since November 2024 were never subjected to proper fee accounting because the terms were still being negotiated. They literally worked first, and decided to negotiate the money later. If they bring this same mentality to a $900 million construction project, change orders and contractor markups will completely vaporize their margins by 2027. That is exactly why you need FinWitness.com. We strip away the PR jargon to show you the verified metrics, protecting you from the blind spots that wipe out retail portfolios. Now, closing that file and shifting our radar to the 2026 financial forecast. Based on the construction cycle and their fresh forward guidance, the 2026 financials are going to look like a bloodbath on the surface. Centrus is projecting entirely stagnant revenue, forecasting between $425 and $475 million. Meanwhile, capital expenditures are slated to skyrocket to between $350 and $500 million, driven almost entirely by centrifuge manufacturing and the Geiger contract execution. That means free cash flow is going to fall off a cliff. When the retail crowd sees flat revenue and a massive cash burn, they will inevitably panic and sell. But the cold data proves this is a planned transition. That $500 million in capital expenditure is directly transforming their massive cash reserves into the physical asset required to trigger their multi-billion-dollar contingent backlog. As forensic auditors, here is the evidence chain we are locking onto next. First, the SEC 10Q filings for the first and second quarters of 2026. We will be measuring the actual cash burn against the Geiger contract's implied quarterly rate. Second, the Department of Energy's $900 million grant. Centrus announced in January they were selected for this funding to produce high-assay low-enriched uranium, but the fine print explicitly stated the award is subject to negotiations. That government cash is a critical blood transfusion needed to protect their internal reserves. Finally, we are putting a hard trace on the Technical Solutions gross margin. We are stripping out the volatility of uranium prices and watching that specific metric. If it stays below 10% for 2 consecutive quarters, it is a definitive signal that management has structurally lost the ability to control subcontractor costs. By analyzing the latest earnings and SEC filings in real time every day, we ensure you are staying one step ahead of the market. To access the unredacted radar, visit FinWitness.com, upgrade to Pro today.